Welcome options traders. I just wanted to post a quick video here on an interesting article that was sent to me by one of the traders in this group, and I appreciate that. It's always nice to use a real-world example for training purposes. And this is a major money manager fail, and my goal is not really to bash this person, although, interestingly, it was published in what's called the Wealth Management Journal, which is a publication of the Wall Street Journal. So if you're going to hold yourself out there as a money manager expert and an options expert, I think that they should be called out when they are far from it. But my main goal is to show you why it's important to understand this stuff for yourselves. You need to understand principles of finance in investing and options, because there are a lot of people out there who will try to convince you that they are experts when they're really not. So let's take a look at the article. So this was the headline. Now this was back from 2014, but it's still a relevant example because people make this mistake all the time, long before 2014, and they'll continue to do it for eons going forward. It's an easy trap to step into. But the headline says, credit spreads help boost clients' retirement income. Now, I know that's client singular because he's talking about a specific client right here. And he's saying, here's a 78-year-old guy, really tight budget, and we're trying to get more income coming into his account. Well, hey, what better way than with a credit spread, right? If you can get credits to your account, you're receiving money, and therefore your income is getting boosted. Well, that's the myth, and that's the illusion, because his headline could have just as easily said, debit spreads help to boost clients' retirement income. Now, I know you're probably going, what? How is that possible? How could you be spending money with a debit spread and actually boosting your retirement income? It certainly seems to make sense that we should be using credit spreads. Well, that's what this advisor thought, and in fact, one of the lines in the article said, we talked about ways to raise his income without taking on too much risk. So notice a key phrase right there, raise his income. That certainly implies that we are bringing money into the account. And again, this is the big myth that so many people, including supposedly experienced money managers, fall into. They think it's all about selling these vertical spreads, what's called a credit spread, to earn cash. So to talk about the mistake here, I have to give you a quick background on what a vertical spread is. I don't have time to go into all the ins and outs, but a vertical spread is a type of option strategy where you are going to be long and short two options at the same time. So in other words, you're going to buy an option, let's say a call option, and you will sell another one of the same type, meaning that if you bought a call, you sell a call, or if you bought a put, you sell a put. That's what it means to be the same type. And they both must have the same expiration. That is a vertical spread. Depending on the way it's constructed, in other words, depending on which strike you're buying and which one you're selling, it will result in either a debit, meaning you have to spend money for it, or it could result in a credit, meaning that you receive money. Now again, right off the bat, it looks like, hey, there's no question. Credit spreads are better because it's better to receive money than to spend. But the thing that everybody misses is this. When you do a debit spread, it's an asset. You own something. You have something that can appreciate in value. And when you do a credit spread, it's a liability. And that's not necessarily saying it's a bad thing. It's just not an asset. You're not making equal comparisons. You're getting paid to accept a liability. So one of the things that I always ask people like this is they'll say, well, which is better, a debit or a credit? Of course, they want to force you to say a credit. And my response is, well, which is better, an asset or a liability? And they'll say, well, what are you talking about? Well, the credit spread that you're doing is a liability. And if you think that an asset is better, then why are you doing liability spreads? And that's when you start to get the blank stares and they don't quite understand what you're talking about. So let's take a look at the difference between the debit spread and the credit spread. Let's start off with buying a call spread. In the article, he talked about the 535, 540 vertical spread, so I'm going to stick with those strikes. But let's talk first about buying the call spread. I think it's easier for people to understand. And to do that, let's say that you bought the 535 call and sold the 540 call. As I've talked about in previous videos with the profit and loss diagrams, we can see that the 535 lines up right here with one strike. That's the option that we own. And then the 540 strike lines up right here With the other bend in the graph, that's the option that we sold. And because we have the right to buy shares at $5.35 and the obligation to sell them at $5.40, the most we can make is the $5 difference in strikes. And that's why we have a limited loss down here, and we also have a limited gain. That is a characteristic of all vertical spreads. So let's just say that hypothetically, this vertical spread is priced in the market at $3. That means you have to spend $3 or $300 per contract. So we have to shell out $3, and if the most the spread could ever be worth is $5, if I paid $3 for it, then the most that I can put into my pocket is $2. And notice that those two numbers there, 3 and 2, not counting the minus sign there, but they add up to the difference in strikes, and that will always be true. But in this case, because we had to spend $3, the broker is always concerned with your maximum loss. The broker couldn't care less about what your maximum gains are, has no concern to him. He wants to know, how much can you lose? So if your maximum loss in this example is the amount that you paid, then you will have a margin requirement equal to $3. And that means you have to set aside $3 before you can put this position on. It's what's called a 100% margin requirement. So remember that. We have to set aside $3 up front, and in exchange, we might make $2, provided the stock is above this 540 strike right here at expiration. Doesn't matter where it is, can be anywhere up in here, all the way out here. As long as it's above that 540 strike, we will make the $2. We'll also notice that when you buy a call spread, it's bullish. We need the stock price to go up in order to make money. Well, if buying a call spread is bullish, it makes sense that buying a put spread should be bearish. And you'd be correct. We could get a similar looking profile, limited losses, limited gains, by purchasing a put spread. So in this example, if I bought the put spread, I would have to purchase the higher strike, because there's a principle of options trading that says higher strike puts have to be worth more money. They give us the right to sell shares at a higher price. So I must own the 540 put, and I have sold the 535. And therefore, it's going to result in a debit. I own the 540 put, but I'm selling this one off to reduce this cost a little bit. That's my motivation for doing a debit spread. But if I buy a put spread and I'm bearish, what would happen if I sold the put spread? Can't I sell a spread? Sure, you can buy a call, sell a call. You can buy a spread, you can sell a spread. Well, if the put spread buyer is bearish, like we're seeing here, what would happen if we sold it? Wouldn't that flip us around? Of course. The seller has the opposite outcomes and the opposite outlook as the buyer. And that means I can make this a bull spread by simply selling the put spread. I know it can get confusing, but just understand that I can get to the bullish side with a spread by using calls or puts. I can get to the bearish side by using calls or puts. I can get to those sides by using debits or credits. I can get to premium collection by using debits or credits. A lot of things that people say that can't be done, they can all be done whether you're using calls or puts or debits or credits, because there is a principle in options trading when it comes to spreads that says buying the call spread is exactly the same thing as selling the corresponding put spread. And by corresponding, I mean that they have the same strike. So in this example, if we buy the 535, 540 call spread, we get exactly the same profile as if we had sold the 535, 540 put spread, which is the one that he's talking about in this article. They're exactly the same thing. And conversely, buying the put spread is exactly the same thing as selling the call spread. And these are mathematical outcomes of another type of spread called a box spread. And that's what's making these principles hold true. So the thing to understand for now is that if you buy the call spread, you are doing exactly the same thing as the trader who is selling the corresponding put spread. Well, if the 530, 540 call spread is selling for 3, then the corresponding put spread must be selling for a credit of 2. And because it's a $5 liability, that means your maximum loss could also be 3. Notice that the two are identical. So now ask yourself, what's the difference between buying the call spread on the left and selling the put spread on the right? Both of them result in a debit of 3 and a maximum gain of 2 if the stock is above 540 at expiration. But if you sell that put spread, There is no income. It is a debit spread. You're not increasing your income at all. Well, then you might ask, well, if there's no difference between them, then what's the harm? Good question. Let's bring up a stock. I'm going to use Amazon instead of Apple because we've got some really good skews here going for the example. But for instance, let's say we come down, let's go to the 1 week option here, which is what he was saying that he was selling, or a vertical spread. I've got verticals here. So these are all vertical spreads, and notice that they are $5 wide. I could change that, but let's keep them at $5 wide. Now also notice that the stock closed at 2003 even, and let's say that we bought the 2005 spread. If I bought the call spread over here on the left, the mark, which is the midpoint between the bid and the ask, is 270. So if I pay 270 and I can make 5, the most I can earn is $2.30. Well, before you place that trade, look to the corresponding put option on the right. Let's come over this way. I could sell the put spread for $2.25. So notice by buying the call spread, I could potentially make $2.30. By selling the put spread, I can only make $2.25. This is my credit. That's the most I will ever receive. And I could also say if I can lose 5, that means the most I could lose would be $2.75. Back over here on the left, the most I can lose is $2.70. So in this case, I'm actually better off with a debit spread, even though this money manager would have definitely put you in the credit spread. Why? Because he thinks you're receiving the money. But does that mean that the debit spread's always better? Not at all. Here's a case down here. If I buy the 2010-2015 call spread for a debit of $2.25, the most I could make would be $2.75. Well, what would happen if I sold the corresponding put spread? Look directly across the board. I could receive about $3.30. Well, that's a whole lot better than $2.75. So in this case, I would prefer to sell the put spread. Now, this is a little bit oversimplified because if I can get this extra money on the put side, theoretically, I should be able to trade the debit side for that same difference. But that's, again, something that advanced traders would know. There are also other considerations, things that we call morphs. If we think the stock might break out and I want to get bullish, I might lean towards the debit spread because it will be easier to get long if that stock breaks out. And I don't want this limited upside. On the other hand, if I'm convinced that the stock is going to stay in this range or lower, I would probably sell the put spread. Also, if I thought it might break to the downside, I might want to get bearish, in which case I would rather have the ability and the access to go long a put. And therefore I might be willing to sell the put spread. So there are other considerations outside of just the prices. But this money manager never even got there. It's strictly that he's looking at the prices and he's assuming that because it's called a credit spread, he's raising incomes. He's not. He's creating debits in each and every one of those spreads. Interestingly, in the article, the author says, careful stock picking and monitoring of stock prices helps him protect his client's money. Well, let's just hope that his stock picking ability is much better than his understanding of option strategies. If you'd like to learn more about the art and science of options trading, please check out the Alpha Trader course and Strategy Lab at optionsaToZ.com. Also, please join us on the Facebook trading group Options A to Z, and you can find a link in the description below.